Essence of investment funds. The power of collective investing. Imagine you have only $2 and stand in front of a snack shelf. Cookies, chips, candy, crackers. You can only choose one, and if it's bad, your money is wasted. But what if you and 3 friends pool your money together? Now, you can buy them all and share. That's exactly how an investment fund works. It's a powerful way for many small investors to come together, reduce risk, and access a broader set of opportunities. Instead of betting everything on one pick, you own a small slice of many. That's the magic of collective investing. An investment fund is a vehicle that allows you to access the market without being a financial expert. It transforms the investing process from a solo mission into a group journey. Risk is spread, and growth potential is multiplied. When you invest in a fund, you're not just putting your money into one stock. You're gaining exposure to dozens, hundreds, even thousands of assets. This diversification helps you minimize losses when individual stocks drop and maximize the potential of your entire portfolio growing over time. Many believe that investing requires deep expertise. That's where funds come in, to empower people who are busy, inexperienced, or simply want a streamlined way to grow their wealth. Picture yourself stepping into a vehicle guided by professionals, headed toward a more secure financial future. You don't need to be the driver to reach your destination. A well-structured investment fund becomes your vehicle, efficient, guided, and focused. The real magic lies in the synergy of pooled capital. Alone, you might never afford to buy a slice of Apple, Tesla, or Amazon. But through a fund, you gain fractional ownership in all of them. This is called diversification, one of the most critical principles in modern investing. Funds act like a safety net, catching you even when one stock plummets. That safety makes long-term investing not only more stable, but also more rewarding. An investment fund is more than a financial product. It's a philosophy, one of unity, risk management, and strategic resource allocation. It's a bridge that connects everyday people to the world of professional investing. With a good fund, you're never alone in the market. You have allies, direction, and a proven path to growth. Understanding what a fund really is becomes your first and possibly most important step toward building lasting wealth. Types of investment funds explained. Know the difference, choose the right one. Once you understand what an investment fund is, your next step is learning the key types. Each has unique mechanics, benefits, and ideal users. Don't confuse similar-sounding names. Mutual funds, index funds, ETFs, hedge funds, they're very different creatures. Choosing the right one is a strategic decision that can shape your financial journey for years to come. So let's explore each fund in detail. How they work, what they cost, who they're for, and how they fit into your overall wealth-building strategy. Knowledge is power, and in this case, it's also profit, protection, and peace of mind. 1. Mutual funds. Let the professionals drive. A mutual fund is managed by professional investors who make all the decisions for you. They research companies, analyze risks, and execute trades. You're essentially hiring a financial team to manage your money. The appeal is clear. Less work for you, more expertise behind your investments. But this convenience comes at a cost. Mutual funds typically charge higher fees, called expense ratios, ranging from 0.5% to 1.5% annually. While that might sound small, it can eat away at long-term gains. So, while you gain expertise, you also take on the cost of professional management. Mutual funds come in 2 primary flavors: actively managed and passively managed. Actively managed funds aim to beat the market through constant analysis and strategic moves. The fund manager is deeply involved, tracking stocks, predicting trends, and trying to maximize gains. But studies show that most actively managed funds struggle to consistently outperform the broader market, especially after accounting for fees. Passive mutual funds, often just called index mutual funds, take a different approach. They simply track a specific index without trying to outguess it. We'll explore these passive funds more in the next section. Another key trait of mutual funds is low liquidity. You can't trade them like stocks during market hours. Orders are only processed once daily after the market closes at the fund's net asset value, NAV. This means you can't capitalize on intraday market swings or react quickly to news. For some investors, this stability is comforting. It discourages emotional trading. For others, it feels restrictive. The right fit depends on your personal investing style and patience level. Either way, understanding this mechanism is crucial before choosing a mutual fund as your investment vehicle. Minimum investment requirements are another hurdle. Many mutual funds require an initial investment of $500 to $5,000, sometimes more. For new investors, this barrier can be discouraging. But for intermediate investors looking to hand over control to professionals, it might be worth the trade-off. Funds with strong reputations and performance histories include Vanguard VP Max, Fidelity FBGRX, and T. Rowe TRBCX. These aren't just fund names, they're brands of trust, each with its own style and strategy. But again, higher entry doesn't always mean higher returns. Index funds ride with the market, win with simplicity. Index funds are the champions of simplicity and consistency. Instead of trying to beat the market, these funds simply mirror it. For example, an S&P 500 index fund invests in the 500 largest U.S. companies. No guessing, no analysis. If a company is in the index, the fund buys it. This means less active management, lower turnover, and dramatically reduced costs. It's a set-it-and-forget-it strategy that has outperformed most actively managed funds in the long term. Why? Because it minimizes fees and eliminates human error. Simplicity, when applied with discipline, becomes a superpower in investing. The biggest advantage of index funds is their ultra-low fees. With no need for constant trading or teams of analysts, they pass those savings on to you. Expense ratios can dip as low as 0.03%. Compared to 1% for active funds, that's a massive long-term difference. These tiny savings compound over decades into thousands, even tens of thousands of extra dollars. For budget-conscious investors, or those building wealth slowly over time, index funds are a no-brainer. They're built on discipline, not prediction. And in the long run, that discipline pays off more often than not. Index funds thrive on patience and belief in long-term growth. You don't need to time the market. You don't need to guess what's next. If you believe the U.S. economy will grow over time, investing in an S&P 500 index fund like Vanguard's VFIAX makes sense. If you believe tech will lead the charge, consider a NASDAQ 100 index fund. It's not about picking winners. It's about owning the entire field and letting time do the heavy lifting. Consistency beats cleverness when the timeline stretches decades. There are two forms of index funds: mutual funds and ETFs. If you buy an index fund structured as a mutual fund, it behaves like any other mutual fund, traded only once daily with similar rules and limitations. The key difference is it's passively managed, keeping costs low and strategy simple. Popular examples include FNILX, SVPPX, and VFIAX. But if you want more flexibility and modern features, you may want to consider ETFs instead. That's where we're headed next. 3. ETFs. Flexibility meets strategy. ETFs, or exchange-traded funds, blend the best of both worlds. Like index funds, they're often passively managed and cost-effective. But unlike mutual funds, they can be bought and sold like stocks during market hours. This gives you the flexibility to react to news, market shifts, and personal goals in real time. That's why ETFs have exploded in popularity, especially among younger investors and tech-savvy traders. They offer simplicity when you want it, control when you need it, and efficiency all the way through. Think of ETFs as the smartphone of investing: versatile, powerful, and always in your pocket. ETFs come in both passive and active versions. The majority are passive, tracking indexes like the S&P 500, VOO, NASDAQ 100 QQQ, or global markets, VT. Want to invest in semiconductors? Try SMH. Want exposure to disruptive innovation? ARK. Some ETFs even focus on cryptocurrencies like Bitcoin. With a single purchase, you gain exposure to dozens or hundreds of stocks tied to a specific theme or sector. It's like buying a basket of curated opportunities, instantly diversified and tailored to your convictions. Another key benefit of ETFs is the low entry barrier. You can start with just a few dollars or even fractional shares, depending on your trading platform. This makes ETFs incredibly beginner-friendly and accessible to virtually anyone. Plus, their low fees and tax efficiency make them ideal for long-term investors. While they provide the same diversification benefits as mutual funds, ETFs give you more freedom, more liquidity, and often more transparency. They're not just funds, they're tools for building the future on your own terms. 4. Hedge funds. High risk, high reward, high barrier. Now let's talk about hedge funds, the elite realm of investing. These funds are only accessible to high net worth individuals and institutions. Entry often requires $100,000 or more. Hedge funds use aggressive strategies: short selling, leverage, derivatives, market hedging, and speculative bets. Their goal isn't to match the market, it's to crush it. Managed by some of the world's top financial minds, these funds chase high returns with high risks. Think of them as private jets of the investing world: fast, powerful, exclusive, and not without danger. Hedge funds also come with the heaviest fees. The traditional 2 and 20 model charges 2% of assets under management plus 20% of any profits made. It's expensive and not always justified. While some hedge funds outperform the market spectacularly, others underdeliver despite the hype and cost. Lack of transparency and limited regulation make them even riskier. Funds like Bridgewater, Citadel, and Millennium dominate this space. But unless you're ultra-wealthy, deeply informed, and comfortable with volatility, hedge funds are more fantasy than necessity. For most investors, they're better studied than joined. Pros and cons of each fund type. Now that you understand how each type of fund works, the next question is obvious. Which one is right for you? There's no universal answer, only smart choices based on your goals, risk tolerance, and level of involvement. The key is to compare 4 critical factors: flexibility, cost, safety, and suitability. Choosing the right fund is like choosing the right vehicle. Each gets you somewhere, but not all are designed for your path. Let's break it down and help you make a decision rooted in logic, not hype. A great strategy starts with knowing what fits you best. 1. Flexibility. If real-time control matters to you, ETFs shine. They can be traded throughout the day like regular stocks. This allows investors to respond quickly to news, lock in gains, or cut losses. Mutual funds and index funds, in mutual form, don't offer this. You can only buy or sell once daily, based on the fund's NAV. Hedge funds, meanwhile, are private and often have limited liquidity windows. Flexibility gives power, but it also tempts emotion. If you're easily swayed by market noise, less flexible funds may actually help protect you from impulsive decisions. 2. Cost and minimum investment. Index funds and ETFs are clear winners in terms of affordability. With fees often under 0.1% and little to no minimum investment, they're incredibly accessible. Mutual funds typically charge higher fees, especially those actively managed, and often require $500 to $5,000 to get started. Hedge funds are in a league of their own, requiring $100,000 plus and charging up to 20% of returns. For beginners or budget-conscious investors, index funds and ETFs offer outstanding value. Remember, every percentage point saved in fees can translate to thousands in your long-term wealth. 3. Risk and safety. Index funds and ETFs track broad markets, which means lower volatility and less reliance on human judgment. Mutual funds, especially actively managed ones, carry more risk depending on the manager's skill. Hedge funds take the biggest risks, often betting on market declines, using leverage, or engaging in complex strategies. Diversification helps mitigate risk, but the overall structure of the fund matters. If you seek long-term stability, passively managed funds are typically safer. High-risk vehicles can bring high returns, but they require emotional strength and expert insight. Know your limits before chasing performance. 4. Who should choose what? If you're just starting, index funds and ETFs are your best bet. Simple, low cost, and beginner-friendly. If you're intermediate and want to hand off decisions to professionals, mutual funds may work. Just watch the fees. For the experienced investor with capital and confidence, active ETFs or hedge funds offer potential upside, but demand greater risk management. Ultimately, don't follow trends. Follow your strategy. The best fund isn't the most exciting, it's the one that aligns with your goals, your risk comfort, and your timeline. That's how real wealth is built. Performance, actives, passive. When it comes to investing, everyone dreams of maximizing returns. That's why many investors assume actively managed funds, run by experts, will outperform passive ones. After all, professionals should be better at picking winners, right? The reality is more complex. Over the last 2 decades, data consistently shows that most actively managed funds fail to beat the market in the long run. Meanwhile, passively managed funds like index funds and ETFs quietly deliver stable growth. It's a surprising truth. Following the market often works better than trying to outsmart it. Consistency, not complexity, often leads to greater wealth. Why does this happen? It all comes down to fees and human behavior. Actively managed funds incur higher costs due to trading frequency, research, and portfolio oversight. These fees eat into your returns, especially over long periods. Worse, fund managers are human. They make emotional decisions, react to market noise, and sometimes chase trends. Passive funds avoid this by sticking to an index. No speculation, no impulse. Just a long-term, rules-based approach that favors discipline over drama. The absence of emotion in investing is often a hidden advantage, and it's built into every passive fund. One study from S&P Dow Jones revealed that over 80% of actively managed U.S. funds underperformed their benchmark indexes over a 10-year period. That means if you simply invested in an index fund tracking the S&P 500, you likely outperformed most professionals without lifting a finger. Why? Because passive strategies reduce friction, fees, and failure. This doesn't mean active funds are useless, but it highlights a clear truth. In most cases, slow and steady truly does win the race, especially when you remove costly detours and emotional pitfalls. That said, some active funds and hedge funds do outperform in specific market conditions. With the right timing, research, and luck, high returns are possible. But these cases are rare and hard to repeat. Most investors lack the time, expertise, or discipline to consistently identify winners. That's why passive investing remains a smart strategy for the majority. Let the market do the work. Focus on time in the market, not timing the market. Because in investing, the tortoise usually beats the hare. Choosing the right fund for you. There's no one-size-fits-all in investing. The best fund isn't the one trending online or promising outrageous returns. It's the one that aligns with your goals, timeline, and risk tolerance. So, before choosing a fund, pause and reflect. Are you just starting out or already experienced? Do you want stability or aggressive growth? Do you prefer hands-off investing or active control? These answers matter. Your financial strategy should match your personality and lifestyle. Investment success isn't about chasing noise. It's about building clarity. The better you know yourself, the smarter your fund choices will be. If you're at an intermediate level with a solid understanding of markets and some investing experience, you might explore mutual funds. Choose wisely. Look for funds with strong long-term performance and reasonable fees. You may prefer active management if you believe in the expertise of fund managers and are okay with higher costs. But remember, results aren't guaranteed. You could also blend strategies. 80% in passive funds for core growth, and 20% in active funds for potential upside. A balanced approach allows you to experiment while keeping your foundation stable. If you're experienced and well-capitalized, consider active ETFs or hedge funds, but proceed with caution. These vehicles require not just capital, but serious knowledge, emotional control, and risk appetite. Don't confuse sophistication with safety. You must be ready to endure volatility and potential loss. These strategies can work for those who manage money full-time, but for most, they're best avoided. Remember, the best fund is not the one with the flashiest returns, but the one you can stick with through thick and thin. Long-term success depends on suitability, not sensation. So, in conclusion, investment funds aren't about chasing trends. They're about aligning strategy with purpose. Whether you choose ETFs, index funds, mutual funds, or even hedge funds, the key is knowing yourself. What are your goals? How much risk can you handle? How long will you stay invested? Don't invest based on noise, invest based on clarity. Simplicity beats complexity when matched with consistency. True wealth isn't built overnight, it's built through discipline, education, and patience. So choose the fund that fits your journey, not someone else's. With the right mindset, the right tool, and the courage to stay the course, you won't just invest, you'll transform your financial future. And that's where real freedom begins.